Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. I hope you're all doing well and having a great week. Very excited about today's episode. A lot of interesting things. I'll bury the lead when it comes to mortgage rates. Kind of flat. No news is good news at this point. So we'll celebrate that a little bit. We're going to explore some technology. And actually, just turned out that in my research for technology and innovation in the mortgage industry, my company, Rate, popped up as one of the leaders, and we're going to delve into some of the things that we offer. It's not intended to be a pitch, but this is just to give you an indication of what's capable in our industry. There's a little fun fact segment. I like doing that. Last week, doing the fun fact, this is going to be something that'll just be interesting and fun for you. If nothing else, it's just good fodder for conversation. And then our Did You Know segment, we're going to revisit self-employed borrowers and self-employment and its implications when you're applying for a mortgage, because I read a very interesting statistic this week that I thought, well, then it's appropriate. Let's talk about this. Without further ado, let's get into it. These are the average mortgage rates across the country as reported by Mortgage News Daily survey as of recording this episode, the Thursday morning before its release. The 30-year fixed-rate mortgage is at 7.08%. The 15-year fixed-rate mortgage is at 6.5%. The 30-year jumbo interest rate is averaging 7.35%. The 30-year FHA mortgage is averaging 6.48%. And the 7/6 SOFR adjustable rate mortgage is averaging 6.95%. Overall, everything is slightly lower than last week. So we've got 2 weeks in a row of some slight improvement on interest rates. Let's flip over to the bond market, see what's going on over there to give us an indication of where things could be heading. The 10-year Treasury yield is at 4.629%. The 5-year Treasury yield is at 4.451%. And the 2-year Treasury yield is at 4.30%. The interesting part there is the 5 years flat week over week, no change there, and just a little bit of modest improvement on the 10-year bond, and the 2-year Treasury yield is up a little bit. What's been going on since last week's episode? Not a lot of economic data. We have the initial jobless claim that was published after recording last week's episode. That came in at 217,000 initial jobless for that week. The forecast was 210,000, so slightly more. And the prior was 203,000, again, slightly more. So a little bit of a tick up as we're starting out the third week of the year. Also, the inauguration was this past week. There's a new administration in. This is having some impact on the market and on the trading in the bond market and essentially the markets that affect mortgage rates. There's a lot of conversation happening, and particularly there was an announcement of at least an intention by the administration to somehow create more affordability due to the constraints of affordability currently, because of the higher interest rate environment and a lack of inventory. If anything, right now, it's important to note what's coming ahead in the week that is about to unfold next week. There's going to be quite a few different things happening that will likely have an impact on mortgage rates. First and foremost, we have tomorrow the National Association of Realtors existing home sales data. I will have a separate episode to report out on that information, so stay tuned. The start of the week will be new home sales on Monday. Wednesday is the Federal Open Market Committee rate decision. Right now, expectations are that there's not going to be any change to the current monetary policy by the Federal Reserve. So we are going to see what that looks like when we get the information on Wednesday. I will report out on that next week on the episode. Thursday, we will have the GDP report. This is going to give us a look at how the economy is starting out this year in the first quarter. And then Friday next week will be the personal consumption expenditure. That's our second inflation gauge of the month. I'll be reporting out on that the episode following, but that is something that is going to have a tangible effect between the Fed and the PCE, personal consumption expenditure. Those are two things that are going to have an impact on mortgage rates. Overall, so far there's been a mixed reaction in the markets. really just reacting to news at this point and the discussions and conversations surrounding tariffs, possible inflationary pressures and expectations, what the new administration has or will be putting forth as initiatives for things that will have an impact on housing, real estate, mortgage rates, and really financing in general. So we will see how these new economic policies could shift things as the year unfolds. But for now, we're just going to keep our eye on the ball to the normal metrics that we look at because they have proven to us to be more reliable in letting us know where things are going in the short term with respect to mortgage rates and the real estate market. Now we're going to explore technology. I always was fascinated by technology ever since I was a kid, with my first Atari 2000 that I got from my parents that my uncle had when he was younger. I was always fascinated by computers and technology. So I wanted to take a moment today to talk about how the implementation of truly innovative technology is reshaping the landscape of mortgage lending, creating efficiencies, and hopefully translating to a much better customer experience and client experience. When I'm talking about this, I'm going to be talking about my company quite a bit. And like I said, this isn't meant to be a pitch or anything like that. It just so happens that Rate is one of the forefront companies in the mortgage world and in the mortgage space, providing a ton of value through innovative tech. First and foremost, everyone talks about AI. I personally am rather invested in artificial intelligence myself. It's something that I use day in and day out, both personally and professionally, in a safe manner, because that's an important thing to understand. And I also happen to give lectures, talks, and seminars about AI, its history, its implementation, and some tips and tricks for both the practical and safe use of artificial intelligence. That being said, artificial intelligence is something that is having an impact on mortgage lending. And a great example is something that Rate is doing. In 2024, in October, we rolled out an AI platform that streamlines mortgage approvals. What that is able to do is essentially take the information that we have and rather quickly, if not immediately, provide loan decisions, which is an incredibly powerful platform. At this point, $15.5 billion worth of loans have been approved and funded through using this platform that we have, and that's 40,000 mortgages in just 2 years. So it's really, really powerful and impressive because it helps to alleviate a lot of the burden of documentation through automated verification platforms, and it helps to really have the mortgage process be something that gets done super quick and efficiently. Secondly, we have the smart underwrite process, which streamlines the approvals. This is something that is not exclusive to Rate. There's other companies that offer this as well, but it's extremely powerful. That smart underwrite essentially takes the information in from a loan application as well as the verification, documentation, and anything else that's plugged in to verify things like income, assets, and credit, and creates an underwriting decision, which is the part of the loan process where you have your loan officially approved. That means you're good to go. And then there may be what's called conditions, which are documents and items that are required so that the loan can be cleared to close, which is the last step. Once a loan is cleared to close, then it's purely a matter of scheduling. For example, I can give you a real world example of a family that I'm assisting purchasing a home. They applied the first Friday of the year, and that's when we started their mortgage application. They had a mortgage approval by Monday, and they only had one condition. We just talked about conditions. And that one condition, that Monday, was to provide us with a homeowners insurance policy, which at the time they couldn't provide because most insurance carriers will only bind policies for insurance 30 days out from their closing date. And that first Monday of the year was just a little bit further outside of 30 days from their target closing. So they had to wait a little bit, and then they were able to get us the insurance policy. We cleared that loan for closing by that following Friday. This is the power of the technology that's available in our industry now. In addition to that, there's some really other cool tools behind the scenes that empower me as a mortgage professional to be super communicative, be able to respond to inquiries for pre-approvals and provide them on the go within minutes, which is super powerful and helpful, especially considering how challenging and how competitive the real estate market is. Efficiency and speed is, in my assessment, a requirement of success in the real estate market right now. So the fact that we have these tools is super helpful. And again, this is not necessarily exclusive to what I offer. There are other lenders out there that have comparable platforms and things to empower their sales force, their mortgage professionals, and to provide the best possible client experience for the clients and families that they serve. In addition to this, I'm going to just touch upon artificial intelligence one more time, because the main point of this is this AI platform, in particular when it's in the mortgage space. These are AI platforms, unlike your large language models of ChatGPT, Perplexity, Claude, Gemini, where everyone, other people can set up accounts and go in. These are under lock and key. These are platforms that are created in a secured environment for the protection of borrower information and client information. So there is a tangible difference that these AI platforms that are being implemented are under lock and key, encrypted, and all safeguards possible are implemented for the protection of the consumer. In addition, that's on the safety side, but on the client experience side, it is extremely powerful. Just that one example of the family I assisted with their mortgage, 7 days for a clear to close is phenomenal. They were prepared to close a whole month before their closing date. And it was really funny. I'll share one little story. I was catching up with the clients and said, we're all set. And they were, reaching out to me like, are you sure? Is there anything else that we need to do right now? And no, that's the beauty of it. And to me, that is tremendously important, that there are tools available and platforms available that can provide that level of speed and accuracy that can help people have, dare I say, an enjoyable experience when purchasing a home. Look, in my opinion, you're going to be grinding it out as a home buyer, particularly here in New Jersey and North Jersey, but the whole New York metro area this applies to. You're going to be grinding it out because it's so competitive and the number of opportunities are limited due to low inventory. So I feel as though the onus is on us as mortgage professionals to provide our clients with the easiest possible process possible, because all of that hard work is already being done. The last thing you're going to want is then, after you finally get an offer accepted, you're out of attorney review, and you're now moving forward toward your closing date. The last thing you want is headaches in the mortgage process and in the fulfillment side of purchasing your home. So it's really amazing that these tools are available. Now for our fun fact segment. This one was so cool, and it will apply to quite a few people. So if you want to partake in this, go for it. And I would love to see pictures. So follow me on social and tag me if you decide to do this. But this one goes out to those homeowners who have completed their payments for their 30-year mortgage or whatever their mortgage term was. In Scotland, it is a tradition that when you pay off your final payment for your mortgage, you paint your front door red as a proud display of financial freedom from completing your obligation to pay your mortgage. So if you've paid off your mortgage, give it a whirl. Paint that front door red. Let the world know you don't have a mortgage anymore. You cleared it and you did everything you needed to do to attain that level of financial freedom. Now for our Did You Know segment. As I mentioned, I read a statistic this week that I thought was particularly interesting, and it inspired me to revisit this. We have talked about this on past episodes, but a refresher is totally cool by me. And also, guidelines and things change. At present, nothing's changed since the last time I reported out on this, but here is the statistic that I read this past week. Currently, 36% of the U.S. workforce is in what's called gig economy. So gig economy, things like driving for Uber, really, and that kind of encompasses self-employment. So since COVID, there was a shift. There were a number of people who started to question their routine jobs that they were in, and they've now sought self-employment, creating their own businesses, working in a gig capacity where, it's project-based and they get paid directly for the services that they specialize in. I myself, beyond being a mortgage professional, I'm a musician. I am part of this in some capacity. I perform at bars and restaurants. I perform at private clubs. I perform at public clubs, private parties, things like that. That is part of the gig economy. And that's just one example, but that can apply to individuals who are, like my wife, a graphic designer who does graphic design work on the side, even though she's a teacher as well. There are, take your pick of any other types of pursuits that are considered gig. So let's talk about what does that look like if you're trying to apply for a mortgage, if you're in this classification, which is self-employed. So starting out, overall, conventional loans and FHA, 2 years of self-employed history are required. And that's kind of your standard operating procedure. Now, that being said, when you have the 2 years of history, that's the minimum. If you've been working for 5 years or more self-employed, Fannie Mae and Freddie Mac, those are the two government-sponsored entities that provide the guidelines for conventional loan financing, do permit only 1 year of history to be documented for purposes of qualification income and reviewing your finances. So there's a little bit of a benefit if you've been self-employed for a longer period of time, particularly 5 years. That we rely on the automated underwriting system that we leverage when we are reviewing loans for our borrowers and for our clients. And if the automated underwriting system says this loan is eligible for 1 year of tax returns or 1 year of verification of self-employment history because they've already documented that they've been self-employed for 5 years, that's something that's accomplished by a letter from the CPA that prepares the taxes, and we have different iterations of verifying that. So 1 year is possible. There's some benefits to that. So if we look at the 2 years, and we'll start there, we look at 2 years of self-employed history, we are basing your qualified income on a calculation that's set forth by the loan guidelines we follow for conventional or FHA loans, and we take the net. So after expenses and write-offs from a business, we use the net income. There are a couple opportunities for us to add back in certain expenses, but by and large, we're using the net income. If you make $1 million as gross sales for your self-employed business and you write off $980,000 in expenses for the business, your qualifying income then is only $20,000. It doesn't matter what that top line number is. We go off of the net. So that's an important thing to understand. The other benefit now, where I'm talking about the 1 year of tax returns, is that we are only averaging out over 1 year. If you have to provide 2 years of tax returns, you've been self-employed for less than 5 years, and or you're applying for an FHA mortgage, we need to look at 2 years. We're going to do a 24-month average of your income over the 2 years. If we see that your income from year 1 to year 2 declines, we're going to actually just do a 12-month average of the most recent year, which is a lower income. This is because underwriting is risk assessment at its heart, at its core. So the onus is to have a conservative approach. And the conservative approach that's dictated by these guidelines is to look at the lowest number, and that's where they make their decision for lending. There are some other important things to understand, because if you are a business owner, there may be expenses that you write off. Things like, let's say a car, and you primarily use the car for business purposes. If you have a car loan or a lease, and that car is exclusively used for your business or majority used for your business, and your business is paying that, so out of your business account, you're paying your car loan. Well, when we're assessing your debt to income ratios, which is part of the qualification process, that is a liability that is already included in your expenses for your business. And if we're using the net, we don't need to hit your debt to income ratio with that expense a second time. If we document that the car is paid by the business, and there's different ways we do that, but if we document it, well, we get to alleviate that liability from your qualification, which is pretty cool. That can be powerful and helpful. The other thing to consider are really the write-offs. So as I mentioned, any of those expenses, you get the tax benefit, which is great. And if you have a quality CPA, you're finding all of the write-offs possible. But there's a negative impact of that. And the negative impact is if you're trying to apply for a mortgage, we go based off of your net. So the more write-offs that you have, the less money you pay Uncle Sam, great, but the less income you have for qualification, not great. So those are a couple things to stay considerate of. There are some other alternative programs available if, let's say, applying for a conventional financing or FHA financing isn't really viable because of what I just mentioned, those write-offs. There are some loan programs that are considered, and they're called non-qualified mortgage programs. Non-QM is the short term for it. So I'll just call it non-QM. Those loan programs permit you to provide 12 months or 24 months worth of bank statements, and we would qualify you as a self-employed borrower based on the cash flow and expense ratio that gets applied to that cash flow based on the deposits coming in to your business bank account. So there are other ways to navigate your qualification if you are a self-employed borrower, which is pretty awesome. A couple implications for that are important to note. Conventional and FHA financing are likely going to be your best interest rate available as a self-employed borrower without consideration right now of credit score, things like that. Those are things that will impact your interest rate. I'm just saying apples with apples. Conventional FHA financing, likely a more advantageous interest rate compared to non-QM mortgages. Reason being, see the comment from earlier, underwriting is risk assessment. If you increase the risk, now the interest rate goes up because mortgages and the interest rates for mortgages are what we call risk-based priced. That's why if you have a 680 credit score, you're going to have a less advantageous interest rate than if you have a 780 credit score. So that reduces the risk, which then in turn winds up reducing your cost of financing, reducing your interest rate. Also, if you are a gig worker or self-employed and there's a seasonality to your business, that is something that we will likely require a little bit more, a higher level of documentation, I'll say. And those are things that we do. That's also why averages are used, because it can kind of mitigate and smooth out any of the seasonality, because then we're looking year over year. So those are a couple things to be considerate of. The main point to take away here is if you're a self-employed individual, if you own your own business or businesses, and or if you are a gig worker, do not assume that you're not going to be able to qualify for a mortgage. Reach out to me. Give me a call, shoot me an email, talk to a mortgage professional. There are ways to navigate that. And now, more than ever, there's more options for you. So if you're not prepared now, there are things you can do to prepare yourself. And those are good conversations. Those are conversations I particularly really enjoy because we get to kind of put together the game plan. If here and now isn't viable, let's talk about how to get it to the point where it is viable. So that's the main point. Simply said, just because you're self-employed doesn't mean you can't qualify for a mortgage. Reach out, look into it. There's tons of resources also available to you online if you would like to look into any of this information any further. That is it for me today. I appreciate you all. Thank you so much for listening and tuning in. If you have any questions, concerns, or things that you'd like me to delve in more deeply on the episodes in the future, reach out to me. You can contact me via email at peter.d'angelo@rate.com. Again, that is peter.d'angelo@rate.com. I would love your feedback if there is anything that you're interested in, or you can follow me on socials. All of my social links are in the episode description. Between now and next week, I hope to have a National Association of Realtors existing home sales review out to you before next week's Friday episode. And then next week, we're going to have at least the information from the Fed. And that will let us know what things are going to look like in the near term. What I will say as a heads up for those that are particularly interested, if you're going to tune in to the Federal Open Market Committee announcement post-meeting, language is going to be important. It's going to be a lot about language because we don't have expectations of any change to monetary policy. So really, everyone's going to be tuning in to what are they talking about? What are their thoughts on what they would need to see for interest rates to be lowered, for them to lower their interest rate again? Let's keep an eye out for that. It's going to be an exciting week ahead. In the meantime, have an awesome weekend and take good care.